Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Well, folks, here we are. It's a wrap for us on 2020, and hopefully you've been able to spend some time with your family, your loved ones, and talk about things that are really important. I know for myself, it's been a extremely challenging year. This has been one of those places that we never could have really anticipated being. How do we get through a pandemic? How do we take care of the people that we care about? How do we find a new way to share love, to look at what's around us and appreciate the things that are really fundamentally important to us? So I'm going to share something personally with you, and it's actually going to be a bunch of 2020. What have we done? What have we talked about this last year at Money on Tap? What has come up again and again for our listeners that it's really important to have conversations about? And I'm going to try to do it in a way that's hopefully fun, not too confusing. It's going to bounce around a little bit. It's just the nature of what it is to try to do the best of show. But really the personal side that I was wanting to share was we're going to call it the nuts and bolts. And I don't know what kind of family traditions you have or things that have been special for you over the years at this time of year. But for me, one of the things that my mom did growing up and still does to this day, thank you, Jesus, is that she makes nuts and bolts. And I grew up with nuts and bolts. Later on, I discovered it's called Chex Mix. If you've ever just had kind of the roasted nuts, the Chex, pretzels. What are the things that are, there's like little sesame things in here. It's just this, delicious mixed up, salty, nutty goodness. And so for us here at Money on Tap, we wanted to do something like that for you. It's just kind of give you the mixed bag of what we love the most of 2020. We're going to call it the nuts and bolts. Hopefully it's something that you enjoy, and hopefully there's things that you can take away and make your own in your personal finance journey. I know Ben and I have a lot of fun putting this together. We really enjoy the connections that we have an opportunity to develop with you, our listeners. So thank you so much for supporting us just by listening and liking and being so gracious to us as we kind of put this information out there, the things that we think that are important for you to pay attention to, and we love to talk about. We care about you. We certainly hope 2021 is incredibly different and prosperous, and a place where some of the things that we've learned through 2020 we can take forward, and we can pass those pieces on to the people that we love and we care about. And for myself and Ben at Brayshaw Financial Group and Money on Tap, that's you. Hope you enjoy.
What are we doing currently about this, and how do we see the market working? And if we were to take a look at 1957, the Asian flu pandemic, 1 million people infected. Okay, how did that look for us in our economy? We had a GDP that was down 10%, significant for the quarter. 3 quarters later, we were up 7.5%. Okay, we're going to talk a little bit about how markets react and what is going on and why is the market doing what it's doing. Here's one reason: stock markets and the markets don't like what is unknown.
Yeah. I mean, that goes without saying, but there's just so much unknown right now that I think, I was saying to one person, I said, I really think we just haven't seen the bottom. You never know when you've actually seen it until it no longer exists. But I think we haven't really seen the bottom because I don't think that the deep fear has really hit. I mean, we've got states getting ready, multiple states getting ready to shut down, 30-day closures, and I think the entire country is going to go that way. Whether you have one case or 100 cases, I was talking to a friend of mine who's in the police department. He said, people are getting mobilized. All the National Guard's getting mobilized. They're getting ready because they're concerned about looting and people's well-being. I mean, when that happens, that's going to be tragedy, okay? And that's when we see maybe another 10 or 15 or 20% down from where we're at. I think we could see well below 15,000 on the Dow, maybe into the low teens if they close the stock market for 3 to 5 days. I think they close the stock market for three days or more. I think people get real nervous about the liquidity of their assets, and I think you see like mass selling. So, it was interesting. I was listening to New Jersey, and I was listening to the essential personnel, and financial services is considered essential on every list. And, and that is absolutely key to people's emotional stability is their financial well-being.
Very true. It's like having air.
So Seth, we were looking at some numbers, and we've sent out a number of different emails, blasts, and stuff like that have talked about numbers. But I think it's good where we're listening to this, and we talked about it last time. But we have some numbers specifically on some pretty crazy events that happened historically, and some bad ones, right? And we're down between 30 and 35% in the market. But if you go back to 1987, Black Monday, okay, which is just a horrific time period in 87, the market was down 33.5%.
Yeah.
Over the next 12 months, we recovered 21.4% return was the next 12 months. So
and that was a pretty short period, too. That was August 25th through December 4th of 87. Pretty short duration there for the market to stay down like that.
Yeah, not
significant.
Yeah, no, not bad at all. I mean, you really have to make sure that if you don't know what you're doing, for the most part, you got to stay in this thing. That's the problem. Because most people, and one of the reports from Fidelity said that, if you stayed in their fund, the return was phenomenal. But, the average investor in some of their funds did horrifically poor. And the poor performance was because people would sell. Every time the market goes down, they sell. When the market goes up, then they buy. No, it's the other way around. Warren Buffett said, the way you make money is to buy when everyone's in fear and sell when everyone's happy.
Yeah. And historically, as a market goes, right, what's typical? 5% happens all the time in a 1-year period. That's very common. In a 16 to 18-month period, we'll get a 10% pullback. Every 36 months, we're going to get a 20% correction. Now, we've been on one of the longest bull markets in history, right? 11 years. And we've had those. But it's kept on going. But now that we've gotten into this bear territory, it's a different conversation for sure. And what we've seen recent history is we've seen about a 50% pullback in the market. Okay? And we're not going back to 1929, and that was much more severe. But in a very recent history, say, 1987 on, that's been very common to see, more common to see a significant pullback of roughly 50%. And we've had those conversations and prepared for these times. And if you haven't gone through this yet and done the planning before, then it's a really scary deal. Or if you're looking at this as, wow, I had $1 million in the market and now it's 500,000, and that's what I'm pulling my income from, that's a really scary scenario as well. Okay? So trying to navigate, pull the pieces together, that's one of the things that needs to happen. And that's part of what working with financial professionals should look like. So let's talk about more of those numbers. Ben, you had a really interesting correlation happening, I think, there where you're talking about the, not correlation, but you were just talking about some of the numbers that were in our more recent history throughout these crises.
Yeah, I mean, we've got a number of them here, but I think there's a couple we can point out that are pretty substantial. I think, everyone's pretty familiar with the financial crisis between '07 and '09, where the market was down about 56.8%. But our recovery over the next 12 months was actually yield you 68% rate of return. I mean, that's pretty phenomenal. You got to remember, too, you're climbing out of a hole, so the rates of return are a little bit easier to create. But that's part of the optimism you have to have inside this. I think one thing that makes us unique, Seth, is the three-dimensional planning that we do, the fee-based, the brokerage, the insurance. And when you can actually utilize all three of those and the mixtures of the investments that drive opportunity inside there, you can create portfolios that have substantial foundations that can prepare you for times like this, that have some sort of backup, whether it's an annuity or cash or gold or whatever it is that you want and however deep you want that protection. I think the thing is people say, how busy are you? How busy are you, Eric?
Busy enough that I haven't been on here in a long time. It's been crazy busy. But a lot of folks are calling in, obviously wanting to check in on their policies, the commercial policies they have. Business interruption coverage is a strong topic right now. And then the others on the personal lines side are looking for some answers. So it's the phone calls are quite a few. Luckily, we're able to work mobily very easily.
Good deal.
But that's the thing. I mean, we're in the financial, the insurance, the whole world. We are constantly in people's limelight, and with everyone home, that's what everyone wants to do. They want to talk to us, and that's great because communication is the best thing to understand. And I think, Seth, I haven't had a phone call to sell or do any sort of mass selling. And I always tell people that when you have that person, because as we audit and teach and train financial planners as auditors ourselves, I've always found that the failures inside some of this stuff, in depressions like this, because that's what it is. It's a depression. It's a financial depression that's happening. We're not having economic collapse. That's a different story. But if you're having a pullback that's in the 20 to 40% range and someone's calling you to liquidate, it's usually because they're in the wrong investment. They're not in something that they thought they wanted, okay? But we have done a really pretty good job with a lot of different management around this stuff. But I have found the conversations, I mean, we've had more money pour into this market and into our office in the last few weeks than we've had in a long time. Big, brand new cash. And that's pretty phenomenal. I mean, that's a great statement for what's going on because the average investor is actually pushing more money in. What's interesting was a Charles Schwab article, Seth, that I saw that said a lot of this downturn is from the short selling and basically the churning that's going on inside basically the day traders, if you want to call it that, not necessarily trading every day, but the constant trading back and forth. The average person's putting more money in every day as this market goes down. That says a lot.
It does. It really speaks very well to, I think, the practice that a lot of us have developed. And if you take a look at the numbers as a whole, we've been saving at a higher rate. What has happened in the economy? I mean, we've had an increase in salaries. We've had a very steady low inflation. Savings rates are higher. All of those things are continuing to help. I think ultimately this is what I would say is if you are that person that's wondering, what do I do right now? Do I continue to the conversation we have all the time? Do I continue to put into my 401k? Absolutely. Do I continue to put into the market right now? Absolutely. Because you're getting a really good opportunity to really light some lighter fluid on your savings strategy.
I think when you're looking at your 401k, the bond holdings are not the option right now. I mean, that's okay. Wait, what are you talking about, Ben? I mean, that's an aggressive play. Don't have bonds. Well, with rates dropping, that's not the opportune scenario. Right now, with some of the big blue chip value stocks paying high dividend yields, you might want to start looking at some other scenarios because if the bonds are going to pay you nothing, well, you might as well leave it in cash or figure out how you want to get allocated. Get some help in that. but being strategic is going to be important right now.
Absolutely. We're going to take a quick break, and we'll be right back. You're listening to Money on Tap. Don't go anywhere.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms, where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well coming up here in the new year. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
More Money on Tap in just a moment.
Ben, how often do we have somebody come into the office and they don't have a financial plan? And how critical is it for us to put the pieces together and make sure that their future, their retirement, is a successful experience? We talk about it all the time here at Money on Tap. If that's you, give us a call at 855-226-8551 or info@yourmoneyontap.com. Whether you have 100,000, 500,000, 5 million, look, folks, we have the right planner for you. Whether it's Ben or myself, Seth Krussman, we're here for you to get the plan together and make sure that that next step is right.
And now back to the best of Money on Tap 2020.
You want to share a little bit about, the investment style and the metrics you guys use inside the Trend Pilot?
Yeah, so Trend Pilot is a trend following strategy. We use the 200-day simple moving average primarily to gain access to an equity index. There's a version of it that tracks the S&P 500, one that tracks a mid-cap index, one that tracks the NASDAQ 100. There's a European version. There's an international version. There's now a high yield version, and then there's a fund-to-fund version. But essentially the way it works is that if whatever index that we're supposed to track is above its 200-day moving average, we own the index outright. And then when that index starts to fall below its 200-day moving average, we start to move the portfolio to T-bills. The whole idea is to just have the portfolio eventually, as the market falls, go to T-bills and stop going down. That we think has value in a portfolio. We know we're not going to get the top exactly right, and we know we're not going to get the bottom exactly right. But what we do know is that if you use a 200-day moving average, eventually, if the market falls, you're going to wind up in T-bills. And when we go through an environment like we're going through right now, where you wake up every day and it's market limit up or market limit down, having some part of your portfolio that's not exposed to this insanity in the market today seems to us to be a pretty good idea.
Yeah, no, absolutely. And I think that's really part of what people are looking for right now is, how do I curb, in a scenario where the stock market drops 35%? I mean, we watch this market fall and then someone says, well, how do I just mitigate a little bit of that loss? And that's something that the Pacer can help you with. The tactical side of investing, Seth and I have talked about for years on this show and trying to manage portfolios through that and weather storms like this. So tell me a little bit about, when you guys pulled out of the market, a little bit about when the 200-day moving average shifted this last session, in the last month or so.
It's an interesting question. Before I answer that question directly, one thing I want to say is that the beauty of an ETF wrapper is that you're able to rebalance ETFs without creating the nasty capital gains that everybody, worries about. And so sometimes when the market starts to go down, everybody has big profits in their positions and they don't want to sell because they don't want to pay the tax. So that's one of the big advantages of Trend Pilot. But if you think about this current cycle, high yield went out first. This old adage on Wall Street that, the bond guys are smarter than the stock guys. So we exited high yield first, and then came mid cap, and then came international, and then eventually the large cap stuff sort of moved to the sidelines as well. It was the last to move, the large cap on the S&P 500. NASDAQ's actually still 50-50 today, but it sort of went in waves, if you will, and it was pretty rapid. They all sort of, kind of day after day after day, the portfolios were all moving to T-bills.
So how do you evaluate the quicker moves that we've seen lately or, versus historically?
Well, I mean, this is unprecedented. What's going on right now? It's never happened before. I guess, the thing about the statement "it's never happened before" is maybe is that it almost always will eventually happen. I guess, but when you look at the market over time, we do go through bear market and bull market cycles, and they don't tend to be as violent as this was. The last violent move down was 2018 at the end of the year, which was a pretty nasty correction. This one became a full-fledged bear market. But the decline was so fast. It was the fastest ever. I think it was 20 days to go into a full bear market mode. That's not normal. Normally, the trend changes over time. I think the reason that this particular cycle down was so abrupt and so violent, if you will, is it didn't start as an economic issue. It started as a medical issue that eventually has turned into an economic issue. And so I think that's why this one's fairly unique.
We are talking to Sean O'Hara, president of Pacer ETF Distributors. If you have questions about the discussion we're having right now, you can reach us at 855-226-8551 or info@yourmoneyontap.com.
If you think about it, Seth, we went to full-blown bear market in like 20 days. And then in the course of a week, we've now had a new bull market, if you measure it by percentages. And
right.
So that makes me a little suspect if you want to know the truth. The average bear market is like a year and a half to 2 years long. I don't think, 3 days worth of a bear market is enough to kind of wash out all the selling, perhaps.
So maybe there is something new here, a bear correction or a...
Yeah, it was like, I like to say it's sort of like an asteroid hit the planet, right? I mean, there's no planning for it. There was no reason for it, really. I mean, stocks were a little overvalued for sure and trading at 20 times earnings, but there was no, we had low unemployment, low interest rates, high labor participation rate. Corporate earnings were seemingly doing okay. It's just that we shut the entire world economy down, it seems like, in stages. And, it started with Italy shutting the whole country down. Then you had, here in the U.S., the NBA, then the NHL, then Major League Baseball had to follow. Then you had counties closing down, and then you got counties go to states, and it just happened so rapidly. And the cure to fight this virus currently is what's killing the economy and the stock market. It's the complete lack of economic activity that we've created as a result of keeping everybody socially distanced and quarantined.
This is the best of Money on Tap 2020.
We have some opportunities right now. Is the market just gotten crushed, right? We went into technically what we consider a recession. Okay. And we've had a bounce back in the market. It's pulled back up, and it's kind of been hovering around where are we at right now?
2,800-ish.
Yeah.
On the S&P, which I think is a little high. The Dow's hovering between 22 and 24,000, depending on 23 and change. We got movement all over the place. It's up and down. But I mean, you really start looking at it over the last couple of weeks. It's been a little flat. Even those huge swings,
pretty flat.
It's pretty flat. Little scary that way, because that concerns me, because that just says to me people are just buying. There's a lot of day trading going on, I think, is what's swinging this stuff. So,
yeah,
I don't know.
So one of the things that you can do if you see a pullback in the market like we've had is you can take advantage of the market being down to take what you have in an IRA and convert that into a Roth IRA. So why first of all do we do what's called a Roth conversion? What's the benefit there? Are we trying to say to you that a Roth IRA is better than an IRA? And they're clearly different. They're totally different tax vehicles, and that's what we talk about. Is they just got this wrapper around them. I mean, what you put inside of an IRA, buy whatever index fund you want in the IRA. You can have that same exact fund in a Roth IRA. No different. So there's no difference there. They both grow tax-free. Okay. But you pay taxes before you put money into the Roth IRA.
So Seth, just to clarify for our listeners, the IRA is the money that I get to, not pay taxes on or get a deduction on my taxes when I file. The Roth is not doing me any good on my tax filing. Like that's the after-tax money. I don't get to deduct anything, right?
Right. You pay taxes on that, and you put it into the Roth. So it's not, there's no tax benefit or benefit to the Roth IRA on the front end.
And both of those grow tax deferred.
Tax deferred. You're not going to pay taxes as they grow.
No taxes every year. I'm good to go.
Right.
Okay.
Every year. Good to go. I like both of these so far, Ben. What next?
Well, the next thing is that the IRA is going to be taxed when I take that money out in retirement as income, as if I never had, nobody ever withheld any taxes from it, and now I've got to pay it solely myself when I take the money out.
As ordinary income.
Ordinary income. So it's not capital gains, it's ordinary income. Okay.
Yeah.
But the Roth, when I take that money out, what happens?
Nothing.
What do you mean nothing?
I mean, I just nothing. It just goes,
Are you telling
whatever.
me I don't have to pay any taxes on that Roth IRA?
Oh, taxes. Yeah. No. Well, no, you do not have to pay taxes.
I like this already. Okay. So what happens if I want to go, like, how do I get a Roth IRA? I contribute to one, or I can do what else?
You can convert your IRA into a Roth IRA.
And sometimes you can take your 401k, and if your company allows it, to convert to a Roth side of a 401k, which is really interesting too.
It is.
So if you're listening here, and we're kind of having a little bit of fun with this because we're laughing, looking at each other. You guys probably can't see it. The thing is,
if you can, let us know.
If you can, then we got other issues. Then we got to talk to Zoom, who we're on right now, and say, hey, you still got some security issues, Zoom. Now, no, in all reality, though, with this market drop, we have had a lot of our clients, and we've encouraged a lot of people to convert their IRAs to Roths. And the problem with this, though, if you're listening, is that you have to pay the taxes on your conversion next year, and you have to pay it out of your own pocket.
Yep.
So if you're currently unemployed, this would be a hardship probably to come up with those tax dollars. But this is a real opportunity if you have the ability to figure out how to deal with this tax. And I personally have converted just small chunks over the years when I had income going up and down in different time periods. I've taken little dollar amounts and converted it and said, well, this is not going to have high impact on me. But long term, I have a huge tax-free opportunity that I am building for myself. It's a little bit every year. So if you're listening, right now is a great time to maybe take a little bit bigger chunk if you're not doing it. Or if you're not doing it at all, do some of it. Mm-hmm. Take advantage of the opportunity to push money into something that will be 100% tax-free later in the future. Both its value and all its growth will be tax-free to you.
Mm-hmm.
This is a huge deal.
Well, what if somebody says, well, I'm contributing to my 401k, but I don't need that, or I'm contributing to my IRA, but I'm not going to need that for income down the road. So this means nothing to me.
Well, you're part of the 0.001% that don't need the money. Is that what you're saying?
Well, yeah. Let's just say, well, I mean, I'm never going to take the money out of my IRA. I mean, how many people have we had? Well, what if I just don't take the money out of my IRA? Then I don't pay taxes on it.
Well, Seth, it's funny that you say that because we do have a lot of people by the time they get to retirement realize I don't really need all this money.
Right. That's because they called Ben.
Well, we hope so. No, but in reality, everyone listening who's putting into a retirement plan saying, I don't know how I'm going to have enough money to retire. That's usually where they're at. So the listener who's putting the money away is going to say one side. The actual user of it's going to say another. I don't want to take this money out because I don't want to pay any more taxes than I have to. Unfortunately, when you hit 72 now, it used to be 70 and a half. When you hit 72, you have to start taking your required minimum distributions.
Yeah.
For those who are dealing with RMDs, our government has actually abstained or allowed you to abstain from taking RMDs this particular year, 2020, as a relief act, which has been pretty nice. The other thing is, and Seth, I think you had mentioned this earlier, and if you need money out of your IRA and you're not 59 and a half or you're younger than that, the government's allowed you to take money out without penalty. Is it pay the taxes over 3 years too, Seth? I think
3 years.
Yeah. So, those are some new things that came out from all the law changes and stimulus packages and everything. So that's pretty interesting. I mean, there's a lot of little helpful things you can do, but I've had some clients who have taken major, I have one client who took about $500,000 retirement plan and converted it to a Roth. It had a significant pullback. It was actually in an annuity, and the annuity value is significantly higher, and they did an actuarial present value test on it, and she got something ridiculously low. We said, yeah, convert that. And now her annuity payments, when she turns it on now, are going to be tax-free, and she can turn it on immediately because she's over 59 and a half, because she won't have taken too much out with a 5-year wait. So I was really, there's some real opportunity.
So you're talking about,
there.
let's talk about that 5-year wait piece, because I think you were just bumping up against that on the 59 and a half thing. And if you're, right now you can take a distribution out of your IRA or your 401k with penalty free, kind of part of this COVID response stimulus package. But historically and typically, if you were to do that prior to 59 and a half, you would pay a 10% penalty right out of the gate.
Correct. Right? Yes.
On the IRA.
Yeah.
Now on the Roth, we're kind of differentiating some of these things here. On the Roth, there's a 5-year corridor, right? And you have, since that money's coming out tax-free, there's a little bit, and you've already paid the taxes, there's a little bit of bonus here, or maybe a bit of an incentive here for you to have some flexibility around those monies. But there is a 5-year wait period on those monies before you can take those out of the Roth IRA.
So, there's kind of some interesting loopholes here that if when you convert, you can start taking money out as long as you in the first 5 years don't go over your cost basis of what you pay the taxes on. So for our client in that scenario, she was over 59 and a half, and we were able to utilize that and create income off of it because she didn't have some sort of crazy gain buried inside that with this actuarial present value. Just a real kind of random scenario. So each one of these things needs to be individually evaluated. But if her case was different, she might, that might not be an issue based on what she was going to take out. She could have, and then you'd start paying penalties if you do go over your cost basis. But it's hard in the first 5 years. If you convert, there's a portion of that is your original cost basis. So, it's a real huge opportunity for people right now.
Yeah. So what we're talking about is really reorganizing and paying attention to the structure of your finances. This is structural in, an attempt to ultimately create a better diversified portfolio and better diversified taxability or future taxability on your income. And if you don't have this ability down the road to be able to think about where does the money come first, second, or how is that money being taxed on the way out, and what can we do to try to reduce or modify the taxability, you will not have the control, and somebody else does.
Yeah, I think one thing I would really take from this entire market craziness, whether we had we had a bear market, now we have a bull market, are we going back into a bear market? What does that look like? What I would tell you is anytime you have market shift like this, you really need to sit down with a planner and figure out exactly where you should be making changes, because it doesn't mean that you're necessarily always going to be making investment changes, but you could be making strategy changes, going from an IRA to a Roth and evaluating how you do that effectively. I did 2 small Roth conversions. I did one about, I think it was a month and a half ago for a little bit when it first dropped, and then I did another one a little while ago. I might do another one if we have another massive pullback. So those are the types of things you want to evaluate. You're never going to hit the rock bottom and make a perfect change. But I'll tell you, last year, early 2019, when the stock market crashed, I actually converted any Apple stock I had in January, in the first week of January.
Nice.
Well timed, well placed. And now I also converted some more Apple stock this last year. So those are things.
And you're an Apple family and Apple guy, aren't you?
I do. I like Apple a lot. I'm a big, long holder of Apple. It's a big part of our portfolios in general. So I do think I'm long Apple, and when I get conversion opportunities and I can absorb that, I'm going to continue to do that.
We're going to take a quick break, and we'll be right back. You're listening to Money on Tap. Don't go anywhere.
If you're listening today and your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
More Money on Tap in just a moment.
Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Krussman, and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show, and we talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group. Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a three-dimensional perspective, and put a plan around your next step. It's so critical, and so many people just leave this part out, and then they find out later, oh, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
And now back to the best of Money on Tap 2020.
We're going to talk about target date funds. And this is
very timely, very, very timely, Seth.
Yes, it's juicy, right? I can't not talk about this.
Well, with the target date fund scenario, we have been talking about this on this show for years. I mean, the lawsuits around target date funds, the management piece that people don't understand, all the different stuff. And target date funds, this article coming out of Market Watch, it's interesting. Target date funds are failing those in the cusp of retirement. Okay. Now, this is by Howard Gold. He says, market sell-off underscores how having 50% in stocks is too risky for people who are retiring now. I think with a target date fund scenario is you don't have a real understanding of the underlying assets well. You're just saying, hey, listen, I want to retire at this date. Take care of me. Have me there. There's kind of this kind of good feeling of assurance, Seth. Like you feel like, oh, I'm going to be all set. And well, people just lost a ton of money, and they're upset. They're very, very upset. And with 73 million baby boomers, okay, that are going to be hurt through this, who were born between 1946 and 1964. So half about them are retired. We got another half coming, and then there's a huge group of people right behind them that are going to be retiring. And this is just destroying. I mean, we've had like 3 or 4 major bear events in the last 20 years, and we're just killing the ability for people to find returns inside this. And you and I have talked about this on the show repetitively about how, not only do we have 120 million Americans between who's retired and who's going to be retired in the next 20 years, but we have a massive market sell-off just probably from those people trying to grab their assets as they sell out, which is only amplified by market downturn. Because if dividend companies aren't paying dividends, we're seeing dividends be shut off. We're seeing all sorts of things happening. And if those dividends get shut off, the person has to create their income, and they're creating the income from a smaller amount of money, not the same amount of money. That's a devastating concept and thing to deal with.
Yeah. One of the things that we actually are doing at Brayshaw Financial right now is during this pullback is we are portfolios from these target date funds and putting them into places where they actually are able to capture an income, capture a return, and we can measure and look at those things. And if you don't have the ability yourself to do this, which I would say 99% of people that are in these target date funds do not, and so that's one of the things that you have to be able to take a look at and see, okay, how am I going to create income? Because the target date fund isn't doing that. What a target date fund, why you're feeling that I have somebody looking out for me, kind of a peace and easy feeling around these things, is because it's kind of like the self-driving car concept, right? And that's wonderful in short periods, maybe, but you really want to have the ability to reach over and grab that steering wheel in the event that something's going on that you need to take control.
Yeah, Seth, I was just talking to a client the other day. I said, you can buy dividend stocks, and as long as they keep paying the dividends and the yields are there, you're happy with the yield, I mean, you can weather storms like this a lot easier. That's just one of the things that you can do, because the value of the stock can go up and down. The value of your portfolio can go up and down. But if you're collecting a yield off of strong companies who continue to pay that yield, that's all part of the mix. Like, that's all part of the story to help, create a little bit of strength inside a portfolio in a market event like this. This is a big deal. And this is honestly probably going to amplify the amount of dividend buying that people focus on inside their portfolios. I don't know about you, but I'm really kind of thinking this is going to surge the dividend stock buying, equity buying play that we've been talking about for years on this show.
This is the best of Money on Tap 2020.
Because honestly, real estate is one of those things that gets the lowest. It's just not that interesting for a lot of people. It's the tortoise. No one wants to talk about the tortoise. Everyone wants to talk about how fast the hare can run. And so what we want to do is kind of get behind the tortoise a little bit today and talk about how sometimes the tortoise can be the hare when no one else is paying attention to it. In today's world, when it comes to real estate, we talked about ETFs earlier, and ETFs being a culmination of stocks. There's what we call REITs, and REITs themselves have their own ETFs, and REITs are real estate investment trusts, and we're talking about traded ones on the exchange. So we're talking about things that have high liquidity. You can buy and sell these stocks or these ETFs regularly all over the place. But there's a lot of interesting real estate out there. So when we start talking about real estate, we can start talking about things. And when I mention these names and these divisions of real estate, some people's ears are going to go up and be like, I don't know if I want to own that. Like, what about an apartment complex real estate investment trust? Or what about an office property real estate investment trust? Or what about a healthcare hospital real estate investment trust? Or, what about like infrastructure, like 5G infrastructure real estate investment trust? I mean, there's lots of domains in which you can own real estate structures and have exposure either into a sector specifically, like infrastructure and 5G, or you could own just an office property, or you could own just an apartment based. You can focus on A quality apartments with granite countertops, or you can do the B quality that have cabinets that aren't that great. But and what's the occupancy rates of these things, and what's going to happen because of Corona? I mean, some people may not want to own an apartment REIT with all the facts that we got the highest unemployment since the Great Depression going on in America right now. So what about those people who can't pay their bills? Do I want to own an apartment REIT? But what about the hospitals? I mean, we have hospitals that are potentially overrun. We have hospitals that are, by no means overrun, and they're laying people off. What is their revenues going to look like for, the medical facilities? And what about infrastructure, and how does that look? There's a lot of different programs. I like some of these. I think there's some that are really, really strong and that we've seen. Seth, I'm just thinking about some of the ones that are going through my head as we're talking here. But we've seen apartment programs have 90+% payments on their rents. Now, 90+ is considered a super positive program, and they never have 100% usually. It's not usually 100% occupancy, and it's usually never 100% payments. There's usually somebody that's struggling in the program, and if you have 100% occupancy, it usually means you're not charging enough. So there's a little bit of balance to that stuff. I think when it comes to real estate and our listeners today, this is an area that has not been highly sought after. We saw a recent rise this last week, which was surprising. But I've been buying REITs and REIT ETFs. I mean, we owned a lot of them last year. I've been buying more this year. I've been buying more as of like a week or two ago, and I've been putting more and more money into them, seeing value and trying to see how these things are going to play out. But some of the dividend yields, Seth, I want to call this show Yield, 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 because some of the yields inside of these REIT programs that potentially look very, very strong because they're so oversold are really strong. I mean, really high.
So you mentioned oversold right there. There were so many places I just wanted to jump in with what you're saying there, Ben. But I think it's important for us to try to add some perspective to what it is that we're saying, because we've worked through a lot of these scenarios and a lot of these pieces here, and we like it because of all these different reasons, and we're excited about it because of all these different reasons. So how do we connect with you right now and help understand what are the parts and the pieces when we're looking in terms of our portfolios or in terms of our clients, what's important? So the market, right, which is, we talked about a little while ago, the market being a rubber band, and it went on such a long bull run that imagine that rubber band being stretched at about the capacity that it possibly can. It snapped back violently because I think of how stretched it was, and because of the kind of the exogenic, which is an exterior to the market, not something that we had in baked into the economy that was failing. This is the coronavirus that came in and swooped down on all of us. And, the market said, we don't know what's going on. And it freaked out and it pulled back violently. Okay. So part of what happened in that is all asset classes, that includes the real estate asset class, took a massive hit. It didn't matter if it was bonds. It didn't matter. There's just not any sector out there that didn't experience a hit through this cycle or this pullback in the market. So publicly traded real estate, folks, is just that. Just kind of like the bond piece that we were talking about in those ETFs, right? Because you're not owning that coupon independently for that bond. You didn't go out there and buy it on the market as an individual holding. You bought the ETF, which has a whole lot of stuff in there. And there's an advantage to that, and there's potentially a disadvantage. What are those pieces? Well, in terms of owning real estate, we talk about the liquidity part of it. The ETF and owning those ETF real estate pieces are liquid. They're on the market. They snapped back. They experienced the drop of March. And so those are some of the buying opportunities, but it's a liquid holding. So it's buying an illiquid asset in a liquid holding. That doesn't make much sense. So in pulling back another layer, we can also, depending on our clients, depending on where they're at, there are also ways to hold real estate in illiquid forms as well. A potential advantage to that over the long term is the illiquidity of that asset and the dislocation from market events like we've experienced. And there are reasons for that we like that as well. But right now we're talking about owning real estate in a liquid form and some of the opportunities that are inside of there. And there's certainly, as you take a look deeper, there are some real headwinds for some of these assets as well. There's plenty of argument to be made that these are going to, the underlying holdings in these real estate holdings are going to be hit in different ways, primarily because of rent. And who out there right now can't keep their doors open or can't pay their rent? Because that's one of the ways that real estate works, right? When you have a building out there and that capacity, or that 90% rental capacity that they're that's a healthy number. We like that. 90% of the units are being rented and they're paying their rent monthly. That's how the dividend or the yield works on that backside there to create that cash flow to come through. Now that we've had this event in our economy, how many of these businesses out there are shuttering and we don't have that rent. So that's the flip side of what we're taking in terms of what we're taking a look at here. And we need to be aware of that as we're taking a look at things.
Yeah, definitely not interested in a retail REIT. I mean, like I'm looking at Simon's Properties. I mean, they're just announced a reopening and there's all sorts of stuff going on there. But man, I don't have a problem going back to the mall, but I'm also looking at the amount of hesitation going in our economy around this coronavirus and all the things that are happening, and the number of people that don't even want states to reopen that are fighting that. They're definitely not going to the mall. I mean, if they don't want the state to reopen, they're not walking around the mall breathing the cycled air, the air conditioned cycled air in there.
I just had an idea. Is there a way for us to roll out a beach REIT? I think a beach REIT would be where everybody's headed towards right now.
Yeah, beach REIT. That's fantastic. I'm all into the beach REIT, Seth.
This is the best of Money on Tap 2020.
Let's start with, so the pro is that you can get into real estate without having kind of this overwhelming burden of owning it by yourself. But what are the cons? Let's talk a little bit about, kind of the problematic items here, because I'm sure that there's some good ones, and I know they're out there. So I'm going to let you take that one. That'll be fun.
Well, kind of like I had a mentor tell me one time that having a partner is not efficient. It can be very effective, but it isn't efficient. So marriages can be very effective, but they're not necessarily efficient because you have to agree on things, or one person is the boss and the other one always feels like they're, following along. So if you have 10 of those, that can get a little tricky. So I'm really making sure that there's, I would say, a managing member who is most experienced, who pretty much just runs the show and they just follow along. It would probably be the most efficient way to do things, but probably going to be personalities that you have to deal with. And then there's others where, you're very hands-off, probably lower returns, but it's very stable. You really have nothing to do with it. You just receive your check. They give you the results or the prospectus and you choose to stay in it, or you can exchange back out.
You talk about hospitality, and I got to be honest with you, when I hear about hospitality or retail, those are the sectors that I think much higher risk in the real estate space. Let's talk a little bit more about the ones that you feel that are much lower risk if you're really willing to take the risk of real estate on yourself. So if we have somebody who's listening here and says, I want to buy a piece of real estate, I'm literally working with a broker, or I'm looking for a broker, they can call you. And you can reach us at 855-226-8551, and we can get you Kira's information. But where are you directing people and say, I really want to get into real estate. I'm looking for a start out piece. I want to do it myself. I've got X hundreds of thousands of dollars to buy real estate, or I qualified for a loan on this much.
Well, again, I always go back to what their long-term goals are. So whenever I bring on a client, if they're brand new, I go over long-term goals, and then I kind of create a plan, a 10-year plan, probably similar to what you guys do. So creating a plan, I'm going to take scenarios, possibly, 3 different options for them that would fit their needs, their management expectations and capabilities, and then also their financial goals. And so I'm going to do a comparison of each of those and do a 10-year projection. And it'll show them what their returns are going to be. And so I'm going to take what they want on all their needs, and I'm going to apply it to properties that I know of. So depending on what they want is going to be the type of property that I recommend. But if it's me right now, I'm looking at flex, small flex, and large warehouse, large industrial are going to be probably the most stable assets for somebody that's just looking for stability. Like I said, value add properties are going to be some great options in retail and multifamily, possibly multifamily, but definitely hospitality.
Thanks for joining us today for the best of Money on Tap 2020.
You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You can also find us at Facebook. We're at /3D Investing. We're also on Twitter at BFG_LLC. And as always, you can also find us at yourmoneyontap.com. Thanks for listening. Thanks for liking our podcast. We appreciate you, and we can't wait to make it a great day and a great life with you here at Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.